Well, Renu Baid joins us, Vice President Research with IIFL Institutional Equities. Renu, good morning. Thank you for joining us. Let's first start with your understanding of the numbers which have come out so far. We've heard from big IT companies, TCS, Wipro, Tech Mahindra. Do you think there is reason to get excited about what you've heard from these managements?
Yeah, I think IT companies probably investors had weighed down on these stocks. So probably things may not be as bad in the US or the developed world the way markets were anticipating. But well, for capital goods, I think the broad market outlook and the outlook on the earnings front is definitely positive.
Talk about the core sector which you represent, the other capital goods space.
Yeah, capital goods, consumer electricals, and
Okay,
electronics.
so let's understand capital goods. This is a sector where massive re-rating has happened. P multiples have expanded. Everybody's excited about what is happening to the capex cycle. And as a result of this kind of a positioning, these stocks are expensive. So do you think we are in for a disappointment this time around and it will be hard for companies to beat and meet expectations?
Not really, because if you see, we had a similar kind of situation last quarter when we were heading towards the earnings season, and many investors perceived that names like ABB, Siemens, which were relatively expensive, are now getting in the same expensive zone, and there would be little room for surprises. But typically, what happens during an upcycle is growth surprises in terms of the momentum. And as a result, the kind of margin upside and operating leverage which comes in, that's really not built in by analysts and investors there. So that surprises. So last quarter, we had almost a 22% kind of upgrade in the estimates for ABB India. So I would say, yes, valuations have inched up because they are pricing in optimism and growth, upcycle growth, which typically happens 25% kind of CAGR in revenues, 30% CAGR in earnings. But that is very well supported by very solid demand outlook and continued momentum in terms of new orders and investments coming through. So probably I think earning disappointments, it may be too early, but yeah, valuations to that extent are trying today to price in this kind of earnings upside as well.
Renu, morning. I wanted to also discuss margins in greater detail, Avan, this side, with when it comes to the cap goods universe as a whole, given the fact that we have seen a normalization in freight costs and even commodity prices to a certain extent. Does that imply that the margin picture this quarter around will look strong?
Margins, yeah, compared to last year, definitely they will look much stronger. Coverage universe is seeing almost 100 basis point increase. On account of two reasons. Last year, most of the companies were still struggling on the cost side. Elevated cost structures were there and the price variation clauses or the entire price transmission to the consumers had not yet happened. So the base was low for the last year. At the same time, if you see sequentially for the last couple of quarters, as commodities have softened and demand momentum has steadily improved, companies have not only been able to pass on the price increases on the product side, but they've also been able to retain the pricing despite softness in commodities. So yes, sequentially margins may moderate a bit, but on a YOY basis, they still remain pretty much firm. And the heartening part is most of the product companies have been able to retain the prices in the market despite softness. EPC companies, in our view, will still take some time because they are in the process of completing the fag end of their project, EPC projects, which were on fixed price basis. So probably their margins will marginally improve on a YOY basis, but definitely from a structural perspective, it will still take about 2 quarters for them, for companies like L&T, KEC, Kalpataru, for their margins to come out of the woes that they have been struggling through.
What, to your mind, is the best way to look at the entire capital goods space? When I say best way, there is a MNC cluster. You got Siemens, ABB. Then you've got defense, which and railways, which in a sense are play on government. And then you got a lot of other companies like Elecon Engineering, ACE, which in a sense are domestic and are a play on cyclicality.
So the way it goes is usually during a capex cycle, the diversified industrials, which in this case mostly are the MNC companies, ABB, Siemens, Cummins, Honeywell, they are the ones which tend to get re-rated the first because the footprint to the diverse capex segments is far better. And at the same time, they are proxies to high quality governance, corporate management, corporate disclosures and other issues. So they are the ones which were always expensive even during the down cycle. I've never seen ABB coming cheaper than 35, 40 times, even the bottom of the cycle. So when the earnings re-rating and the capex upturn happens, these stocks, as you see, they're trading at almost 70 times a year forward there. But the second in line names which are there in terms of proxies for domestic companies. So here you look at names like Thermax, you look at thematic names, could be Carborundum Universal, defense names like Bharat Electronics, Data Patterns. So depending on how some of these end markets are looking, we see that round of re-rating happening. In today's environment, if we see, it's not just the large caps, the large mid caps, but even the small and the micro caps, everything has re-rated because somewhere investors have been struggling to eye and look out for value. So they have gone to the down, the lowest in line in terms of stocks which lag because of issues either on the end markets or the profitability cash flows. But in those stocks today have re-rated. So I would say the entire sector is expensive. Small caps still see a lot of frenzy and interest from investors, but I think high quality franchises will be the best ones to stick with, because even if there are points of moderation and growth, which will come probably a couple of quarters down the line, these companies will be much better placed. So to that extent, we like names like Bharat Electronics, reasonably well priced, defensive name here. We still like L&T in this environment. Valuations are still comfortable. And I think the worst in terms of margins is behind. Margins and order inflow should be supportive for them. Within the MNC space and diversified industrials, we prefer Cummins over the other expensive names. We like ABB, but we think it's relatively expensive at this point in time. And we wait for appropriate correction to add up more. But Cummins is one name which we continue to like. Pre-buy has played favorably very well for them. And demand across all the sectors, be it data centers, manufacturing, services, real estate, everything has been very supportive in terms of the demand outlook for them. So even if CPCB has seen some deferment and dilution because of the new notification which has come through, the end market demand is so robust that it is able to pull through the volumes. So to that extent, these are the preferred names. Certain small cap names like Data Patterns and a few other names probably like Thermax, which have been expensive. I think for those names, incremental outperformance is very challenging. And any disappointment or underperformance versus other peers could be a bit of drag on these names.
Renu, I just wanted to also understand what the outlook is when it comes to tendering activities. Do you think that that momentum is likely to sustain, particularly as well in the run-up to the elections?
Yeah, I think the tendering activity today, if I break them into two buckets, one would be the private sector investments and second is the government sector. So in the run-up to elections, definitely a government sector activity in terms of clearing the project awards in railways, in T&D has seen a very good strong momentum. In fact, even urban metro projects which were there, bullet trains, etc., have seen acceleration in project finalization of tendering activities. And new tenders also for T&D has been up almost 15-20% on a year-over basis. So I think government sector investments in new infra projects over the next 6 months would be very strong. Inflows from government sector will be more front-ended this fiscal because of the elections. But the silver lining and the most encouraging aspect is the private sector investment and capex. That has seen the momentum and the strength being maintained quarter on quarter. Even this quarter, we have seen very strong inflows coming in from the private sector. Large steel capex from ArcelorMittal, etc. We have seen continuous progression in terms of project awards from those large majors. So to that extent, I think the confidence in the broad base private corporate sector capex is very strong at this point in time. And government investments have broadly maintained momentum and they should sustain pre-elections to that extent. So from the sector, I think next 6 to 9 months will remain fairly firm in terms of the investment outlook and order inflow momentum.
Good to know. Thanks very much for giving us a 360-degree view of the capital goods sector. Let's move right on.